All right, guys, we're live. Michael
Spit it.
Zanzini, Lorenza Podda. I almost forgot your name first. That's crazy. I'm an asshole. How could I, man? We're best friends, man. We've been friends for a good time, man. Long time. So how are things?
Good. Can't complain. Every day above ground is a good day.
That's it.
That's it, man.
That's the way that I wake up. People ask, hey, what's going on today, man? How you doing? I'm like, I woke up.
It's true.
That's all you can ask for. Not every day is guaranteed. So
That's right.
it's
That's
on
right.
here. It's a good day.
Yeah, and now we can fight this inflation and interest rates and talk about it, and that's why I got you guys here today to
Absolutely.
get your intake and input and outputs and everything that's happening. It's a very interesting time, and let's dive into it. I don't think we need any more intro here. I think we just jump right into it because it's a wild world out there. So why don't we kind of dive into? I think we revisit maybe like the bond market and what's happening in there. What kind of indicators do you guys look at just to kind of maybe use your crystal ball or prediction of where you see things going?
Yeah, so obviously a lot of people know we have been following the bond yields very closely, and the key reason for this is typically wherever the bond yields go, that the fixed rates follow. So when you see an increase in bond yields, you'll see the fixed rates start to creep up. And similarly, when you start seeing a decrease in bond yields, the fixed rates will start to come down. So we do watch them very closely.
Yep.
And so as of late, obviously the past couple months leading up to the past probably about week or so, or maybe even about a month, I would say the bond yields have been rising, right? Inflation was going up, obviously leading into the last increase week or the last stats we just came up with, but inflation was going up, bond yields were creeping up, and up until about a month ago, we were seeing fixed rates start to creep up just the same. So banks kept hitting us with every couple of weeks fixed rate increase, just not even counting the variable ones with the prime rates that have been moving. So we already see that coming up now. As of late, we have started to see the bond yield come down. I think yesterday closed just under 4% on a 5-year bond yield, which is some really good numbers, or better numbers than what we have been seeing. We're kind of back at those kind of July levels. So we saw from July the bond yield started to increase, and back now they're coming back down to that July level. So hopefully we can kind of keep pushing in that direction, keeping it going lower, and the fixed rates will tend to follow. Now the big thing too, will make people ask, hey, what is a similar, like what should I be looking for in the bond yield, and how does that compare to my rate? Now, One thing we did find, we kind of started charting out what were bond yields like in fixed rate versus fixed rates for the past kind of like 10 years essentially. And what we've noticed in times where there's certainty or not a lot of issues in the economy or anything that kind of people are scared of, for example, COVID was an issue, high inflation was a problem, that's uncertainty. So in times when there's a bit more certainty, usually you see about a 1.5% increase from whatever that bond yield is to the fixed rate. So if we can ideally get the time of certainty and get a 2.5% bond yield, you're at about a 3.99 5-year fixed rate. That's something where the market's going to be really active. If that's possible, who knows, but that's kind of a good way to see it. Now, when you're in times of uncertainty, COVID, high inflation, maybe there's the war that's kind of happening, that kind of creates some more problems. You start to see that kind of spread between the bond yield and the fixed rate to be 2.5%, and that's where you start to see kind of the increases as well. So the whole idea is trying to get to kind of a more stable market. You don't even need the bond yield to come down as much. You just want that kind of price gap to shrink. And right now they are starting to feel like there's a bit of certainty because the price gap isn't too crazy. It's not that 2% number. You're about like 1.75 roughly.
Right. Okay. So to kind of break that down, what you're saying is in uncertain times that spread increases.
Correct. Exactly. Right. So that's another thing to watch out for. So times of uncertainty, obviously rates will be, not necessarily rates will be higher if the bond yield's lower, but just that spread between the yield and the rate's always going to be a bit higher as well. So just something to watch out for. But what kind of plays into that, and the big thing we're always looking at too, is just the unemployment numbers. Because once the unemployment numbers start to creep up, and they slowly are, that's going to start causing bond yields to come down, just because it's going to start hurting the economy.
Right. Mike, what do you think in regards to all the rate increases that we've had over the last, what is it now, year and a half, I guess we're in now, maybe we're getting pretty close to 2. When does this start to trickle into the market, right? And I guess also maybe to add to that as well too, is there, because you've got different banks where the amortization, we've talked about this before too, where the amortization is now like 60, 80, 90 years. Is that causing some of the, maybe not all the pain that's happening right now in the market?
It's a good question. Now, the best way that I can answer this, like you're asking a couple questions.
Yeah, there's a couple in there.
So the first thing is, not all banks payments change when you're on a variable rate. Some of them have static payments. So there's a few banks where as long as you have a variable rate, your payment has not changed on you. through all of these rate increases.
What banks, do you know?
CIBC is one of them that won't change.
We'll get into that, Mike, too.
Oh, sorry, CIBC, you got BMO, RBC, and TD. So those four major ones.
Okay, so those four, so their payments didn't change for any of those clients.
Well, I'm going to get to it. So
Okay.
a lot of people might have heard the term trigger rate. Well, what is the trigger rate? The trigger rate is essentially the bank deeming that now your principal and interest payment, there is not enough room in that payment to cover that monthly payment or that weekly or biweekly payment. So what they have essentially said is, now you have exceeded no more principal payment to that mortgage. You have now been deemed at your trigger rate. So you're essentially paying an interest-only payment now on your mortgage. And the only way to kind of keep that payment in line, now that there is no more principal and interest component to it, strictly interest, you're now seeing these amortizations get pushed out. You're seeing 40, 50, 60, 70 years, right? So when you asked how long does this take to start to feel that ramification into the market, I actually think there's still a lot of people today that haven't really felt the wrath of these increases because their payments haven't really changed, right? So with that,
do we know what the data looks like on that? Like in regards to percentage wise?
Didn't RBC come out and say like 35%, or I think there was a number, don't quote me on that, something like 35% of their mortgage book of variable rates, I think, are coming up.
30.
Yeah.
Okay.
Yeah, so it's a pretty high number. So Scotia's and Nationals, there's the only two that change with the variable rate. So their past, call it 25 or 30 year amortization, is I think as low as like 3 to 5% basically, and that's anyone's maybe going through hard times and asking for it to extend, and that's kind of a whole other topic. But yeah, CIBC, TD, BMO, they were numbers into the 20s and 30s, past 30 year amortizations. Right. So yeah, it was old. They kind of came out with the big chart on it, and it's starting to get pretty high. From the bank's perspective, obviously it's definitely worrisome, but at the same point, they're also short term making a lot of extra interest.
For sure.
So there can't be no.
So they're saying, okay, well, maybe 30% or so of these clients that they have where their amortization has increased, their payments haven't changed, that are going to be coming up for renewal
within the next couple of years.
Yeah,
that's what they're predicting.
We'll go up to what, maybe 2026 or whatever.
That's probably the cap, exactly.
Yeah, exactly. Okay, and so then when that happens, their amortization now has to go back down to 25 years or whatever they had.
Yeah, so as of today, what the rule is, and this could something that could evolve, but as of right now, what the rule essentially is, let's say you took a 5-year variable in 2021, 2026, you're supposed to be at 25 years and your renewal date's coming up, but let's say you're at 65 years. Well, they're going to basically readjust your payment at that point. And this is specifically like one or two of the banks. They'll specifically readjust your payment to get you back down to a 25-year amortization. Now, that's going to be a big jump for a lot of people, right? So,
but what if you were at 10 years? Let's say you had 10 years left to pay.
Well, then typically you're okay because think about it, like if you're 10 years, maybe you got to re-extend it out to 30.
Exactly, that's what I mean. So they don't do 20. They go back to wherever you were, and then you can then
now.
Go.
And most of the time, if you're at 10, though, a lot of times you can call like they'll just you can re-extend amortizations pretty easily with a bank when you just call back, hey, can you re-extend me a little bit up to 30 years? Again, there's a cap to this, right?
Yeah.
So that if you're at 10, typically maybe you might be like 25 or 30 now, kind of thing. It might not be you're too far out. So that's not necessarily the real concern. It's people that are way past the 30-year mark where it's like that's someone that might get kind of hit.
Right. And I mean, look, I know there's a lot of doom and gloom out there, right? And there's people that are saying, well, are we going to have a soft landing? Is this going to be a hard landing? What are your thoughts on it?
It's 50-50. Yeah, if you want to try.
Well, yeah, it's like I agree. Like with Lorenzo, it's such a delicate question because it's like, what do you think is going to happen? At the end of the day, I believe it's still going to be a little bit sticky for the next little while, for sure. As much as we all pray to God, we cross our fingers and our toes. We all want rates to come down tomorrow. Right. Truthfully speaking, you don't want them to drastically drop rates instantly because that can actually have the opposite effect in the market, right? You want to see a gradual decline. Here's my honest opinion. I truly believe we may start to see rates start to maybe slowly fall by next year, going into 2024, maybe late 2024. 2025, we might see a more of a gradual decrease. Like Benjamin Tal, the chief economist at CIBC. When that guy talks, a lot of people value his opinion and his insight. Not saying that he's always a guaranteed scholar. He's right. It's his way or no way. But he came out and he predicted that potentially we might see prime rate get back to 5.2% by 2025. Now, depending how the market goes and the economy goes, how bad things actually get, who knows? We might even see that drop a little bit further.
Right.
We're on a lot of Zoom calls and meetings with a lot of the big banks, obviously being affiliated in the mortgage space. We want to get their insight, what they're predicting.
For sure.
A lot of them are telling us might still be a little bit sticky, a little bit stagnant over maybe the next 6 to 9 months before we start to see any changes. Well, that kind of falls into the guidelines of maybe like we should be prepared to start seeing some decreases by mid to late 2024 going into 2025.
Yeah.
You also have to remember too, back to that statistic with the banks with these trigger rates and these extended M's and variable rates haven't feeling the pinch just yet, all coming up for renewal in 2025, 2026. I have to imagine the banks aren't stupid. They're considering this. They're thinking, if this stays like this, what happens in the next year, 2 years, 3 years? They're planning for this, right?
For sure.
Because I truly believe they don't want to see the economy go to shit. You know what I mean?
Yeah.
Like they're doing everything to try to salvage this, and they're walking a fine line. It's a very delicate line.
I think this is something that people have to understand as well too, right? Is that the banks don't want your homes. They just want the interest. That's it. They want the interest payments, and that's it, right? And so they're probably going to come up. Like what we were talking about this just before we turned the mics on is it was an Equitable Bank. They just came up with a 40-year amortization.
Yeah.
Let's touch on that a little bit. And maybe is that something that we see some of these banks maybe start to introduce again, because they did back in 2008 when I first got into real estate investing.
Yeah, so in that, what we call like B space, essentially like alternative lending. So when you're somewhere who doesn't necessarily qualify with the A lenders, you got to work with kind of a B lender. It's usually the next step.
Yeah.
We've seen a couple lenders kind of stretch past that 30-year AM now. So we've seen couple lenders have a 35, couple lenders have 40. And Equitable is one of the major players in the B lender space. They just came out with a 40-year amortization product. And it's definitely a step in the right direction in a sense. If you're someone that says, hey, we got to help a way to qualify, we got to kind of aid that process, we got to keep people's monthly payments a lot lower. Now, the rate on that right now, and just because obviously rates are so high, it's pretty steep, to be honest with you. I've been throwing around numbers around like the 11% range. So it is a pretty steep price to pay. So it's all about if it makes sense for you as the individual of what your situation currently is, obviously.
So that's their best rate, 11%.
Well,
that 40
but on that, exactly on that product. So at face value, when you're like, oh, Equitable can offer a 40-year AM, like the fine print is you got to take a deeper dive into it. Does it even make sense? Look at the interest rate. It does come with some small fees. Does that payment actually make sense in this product?
So you almost got to kind of run your numbers. Say, okay, does it make sense to stay with the A lender at 30-year AM, or does it make sense to go to a 40-year AM at 11%?
Exactly.
Right.
Now, the one thing I will say, that's also with elevated rates across the board. So now maybe let's think 2 years from now, all of a sudden rates are normalized. That product's still there. That might all of a sudden make a lot of sense at like 6.5%, 7% or something like that.
Are you hearing banks talking about increasing their amortization?
Banks themselves, no, not really. They've talked about it. There's been a lot of talk about it, but to me, like, yeah, there's been chatter, but I haven't seen anything fundamental that I would be like, okay, this is really something.
What are you hearing in some of those meetings that you guys are a part of?
You hear a lot of people asking for it in a sense. The banks don't hate the idea either, to be honest with you, for the most part. The biggest thing is there's the governing body of kind of banks and mortgages and financial services in Ontario. Mm-hmm. They're the ones that are kind of like, well, we don't want to go past that. Mm-hmm. So yeah, the banks.
Sorry, who's that? Who doesn't?
It's called OSFI,
right?
OSFI, sorry.
Yeah. So they regulate.
They regulate everyone. Yeah. So there's been chatter about it, obviously, but there's also more chatter even with getting away with that static variable rate payment where the payment doesn't change. That's something, and to be honest with you, in my opinion, is if that payment wasn't there, I think we would see the effects of these. If the rates wouldn't necessarily need to go as high as they've gone, start affecting people.
Yes.
Right? Because
everybody
gets hit, right?
Impacted if they were in a variable.
Exactly. Which, if we look at the stats, especially from 2020 till now, or that kind of run up in COVID, it was like 70% of mortgage or 60% of mortgage were variable rates. So
that's wild.
It was everyone was taking.
I wonder if have you looked at any data points or stats on this? Like what were those the difference, say, like 10, 15 years ago in regards to variable and fixed? I wonder what that number looks like.
Typically the variable is always a little bit lower than the fixed for the most part.
Really?
Typically it's always a little bit lower. And over history, the past 30, 40 years, the variable rate, if you were to take a 5-year variable versus a 5-year fixed, you were a little bit ahead over history. Mm-hmm. Now, this is the first time when that's obviously been not the case. And even at the time when people were taking the variable rate payments, it was something where the variable rate at the time was maybe 1.75%. The fixed rate was like 3.19, 3.29, 2.79. So you're like, so a normal person running their head, in fairness, is like, well, the rate's got to go up a full 1.5% for me to kind of equal the fixed. Well, I can always lock my variable rate in any time to a fixed rate mortgage.
Right.
So if they start increasing, I'll have time to kind of adjust, lock in. Now with no one, obviously, and people obviously we could, I guess, in hindsight, obviously hindsight's always 20/20. When they do those 0.75 at a time, 1% at a time, now you're kind of stuck. And that's really what would hurt a lot of people, to be honest with you, because if they were to go up 25, everyone for the most part probably would have just locked in.
But you know what though, you make it sound like it's easy to do that, and I'll explain this to you. So last year, when my interest rates were like at around 3.5%, okay,
Yeah.
in September, Darlene and I had to sit down and we made a decision to lock everything in at 5.5, even a little bit higher. Do you know how hard that is to do?
Yeah.
It's hard as hell. And we also, for most of the projects we had to go into a 4 and 5 year because of when we were locking them in. So yes, you can lock in whenever you want. It's not easy to do it either. Because you're like, oh, I'm going into a really shitty rate.
Oh, absolutely.
And you're like, is it really going to go to 5.5%?
Yes.
And that's what we were debating. And we're like, but what if it does? And then do I really want to be in that situation? Because everybody at that time, if you guys remember, were like, hey, just do a 1 year or maybe a 2, but 1 year should be good.
Yeah.
And I was like, I'd rather just lock that shit in. Don't worry about it and focus on other parts of my business.
And it's a mental thing for a lot of people
For
too, right?
sure.
Especially if you're someone that has their own business and real estate's obviously like your passive income or it's your investment property. Sometimes it's easier just to set it aside, know what it's doing is what it's doing, and be able to now focus your brain space on something else versus worry about it. There's also that huge mental component to it that a lot of people don't talk about.
How do you feel about that decision, by the way?
Well, now I feel good about it.
Sure, of course.
But at the time, we were debating it really hard. Like when it got down to actually signing the paper, I'm like, man, I feel like I'm making the wrong decision here. But it was more of, I can't afford it to go any higher. And what if it does? That was really what it came down to. And I mean, and that was when we came up with the whole Red Line series.
Yes,
right?
I remember.
And we're
Yes.
like, hey, look, I'm going to tell you to lock in or do variable, but just find out what your comfort zone is. And don't worry about anybody else. Just what's your comfort level.
It's just numbers. At the end of the day, it's numbers. And like I said, it's going to get stickier before it gets better.
Yeah.
You just got to try to find a way to get through this roller coaster ride and try to just manage it through these payments and these increases, because I truly believe it will get better.
You're close to that mic there. But you know what? You also touched on something as well, too. And I think I mentioned this at our last mastermind event. I think one of the concerns that I have as well, too, because you're saying, like, let's hope they don't lower those interest rates too quick, because I'm not worried so much about a market crash down. It's more of a market crash up.
And it can have that reverse effect that if you have this euphoric downwards pressure. Exactly. So that it's going to be all fine and dandy for a short span of time. And then we're just going to have a bigger problem on our hands, and it's going to do the opposite, right?
Yeah. What do you think is going to happen as soon as they lower those interest rates? That first one.
Well, you have to think about it. There's people that have renewals coming up. There's people that want to refinance, that want to access equity or consolidate debt over these last couple of years of incurring all this debt. You have people that want to sell their homes and buy. You have investors that want to buy. You have a whole whackload of the population that want to be active in one way or another, and they're just sitting and waiting because they're like, where the hell is this going? Are housing prices coming down further? When are these rates going to come down to make that jump? So to your point, they're playing a fine line, the Bank of Canada and the banks and all of them, because the second you drop that significantly and you have this massive stampede flood the market, it's great for the short term, but in the long term, you're creating a bigger problem. And that's that balancing act that you got to play. Because
the question is, if you're having a difficult time even getting into the market right now, what do you think is going to happen when they do lower those interest rates for the first time? Like you're probably, it's going to be gone.
Exactly. And honestly, the answer kind of two parts. To answer your first question, that's from what we've seen is kind of on the front lines. Every time this year that they've said pause on raising interest rates, our office has gone significantly busier right off the bat. Just people calling us, past clients calling us, hey, they're keeping rates the same. What do you think? Now it's significantly busier in activity. When the rates go up, different phone calls coming in. Like now it's kind of, what do I do? But obviously significantly busier in activity. So it's to that effect, as soon as all of a sudden because it's all about sentiment in the world right now, right? So as soon as sentiment changes that maybe rates are all coming down and we're through it, I think you're going to start seeing it, like Mike said, kind of a mass rush to the market.
Yeah.
And we'll see kind of how that goes and where that number becomes. And so yeah, that's kind of what we think might happen. And then to your point, and what was the other one question?
Well, I'm just, as you're talking about the like how they held the rates and that you got a lot busier. I'm actually looking at this one particular article right here, where it says upcoming mortgage rule renewal part of why Bank of Canada held rate at 5%. It's so interesting because prior to that happening, everybody thought that they were going to raise rates when inflation I think ticked back up again. You remember?
Yep.
And it says so. Bank of Canada Governor Tiff McClam says the central bank held its key interest rate at 5%. In part because of the effect a wave of upcoming mortgage renewals is expected to have on the economy. And that was also kind of touching on what we talked about a little bit earlier, right? Like those renewals coming up, let's see what happens with that.
So over the next, remember the busiest time ever in real estate, 2020, 2021. All those mortgages are renewing 25 and 26. So over the next 2-3 years, basically, you're about to, like, I've seen the stats on too, you're going to see the most amount of mortgage renewals come up that we've seen in Canada history, in a sense. So that's kind of.
So why do you believe that?
Well, that's I would kind of the chart statement. I thought all the banks come out saying all their renewals, like the highest amount of renewals they have coming is 25 to 26.
Really?
Because if you think about it, everyone in 2020 and 2021, that's when there was crazy activity happening. Most people took 5 years, right? So, and I've even seen kind of the charting of it, and it's a lot. There's billions of mortgages and billions of dollars in mortgages coming up very, very soon, and that's kind of something where we'll see what happens if they try to kind of bring rates down prior to a lot of those end ones coming. But a lot of people are going to obviously see that increase sooner. So anyone with the renewal right now, it's becoming very, very important to just get planned up early. Get planned early, get your ducks in a row, start contacting kind of your mortgage person just to make sure, okay, what should I be expecting? What can I do? And what's my situation like?
Yeah, I'm going to kind of jump back on that in a minute. But you're right, though, because right now this article here says mortgage payment shock looms as $900 billion.
Yeah.
$900 billion in mortgages set to renew in the next 3 years, RBC says. That's a shitload.
Yeah, it's a big number.
And they're planning for that, and that's the whole thing. I think you're starting to see the cracks start to show now, but the biggest crack that they haven't seen is what's going to happen in the next 2 to 3 years when all of these properties are coming up for renewal, right?
Mm-hmm.
So
what do you think?
Like I said, I actually believe we'll start to see a slight retraction on the interest rates, hopefully by next year.
Yeah.
Maybe a little bit further. Am I saying we're going back to 1s and 2%, ladies and gentlemen? No. But I feel like we can maybe get back to the 5s and potentially back to maybe the high 3s or to the 4s eventually over the next couple of years. A lot of things have to go right to fit that, but it is possible. Right?
What are some of the conversations that you're having right now with some of your clients that whether they're coming up for renewal or they've had to tap in? I'm sure people are tapping into their savings, their retirement. What are some of the conversations that you're having? Are they just like, I need to fuck out of this?
To be completely honest, we see everything from A to Z from the spectrum with our clientele. But to your specific question, A lot of clients either coming up for renewal and reaching out saying, Mike, Lorenzo, Better Mortgage Select, what are some strategies here? You know what I mean? I'm about to come up for renewal. I've been paying 2%, 2.5% on my interest rate here. And now we're getting hit arguably with 6s and 7% interest rates. What type of rates and terms should I be looking at? But is there some strategies to help me get over this speed bump? Mm-hmm. So what we've been doing for a lot of clients, and this necessarily is not always the approach for people, but an option out there. Can we look to consolidate some debt? Can we get rid of some monthly obligations, whether it's lines of credits we've racked up, credit card debt, absorb some of the car loans, shift it now into the mortgage? Can we re-amortize to achieve a lower monthly payment for the short term over the next couple years to kind of make your payment as manageable as possible? Because let's be real here. A lot of people have incurred a lot of debt over the last couple of years, right? Mm-hmm. Just with coming out of COVID, with everything that's going on in the economy, inflation, grocery, gas, everything is expensive. Everyone's trying to just keep 2 feet on the ground and push forward. And it's getting harder and harder. Throw in higher interest rates in your mortgage renewal. That's like a double fucking blow to the gut. Excuse my language. Sorry, I dropped that bomb. But right. So it's
I did it before you did.
Right? So it's like these are some strategies that we are helping our clients with. Try to achieve a lower monthly payment for the short term, planning for their renewals, helping us use this as leverage against your existing bank and getting you better rates. You have to remember, banks aren't always going to hit you with the best interest rates to shop you around and give you the options. Think about it. A bank is going to offer you their rates, their products, sign a piece of paper, and then you're coming up for renewal. Well, working with someone like us or a trusted mortgage professional, you have access to multiple banks. Let's see what else is in the market. Let's see what we can do here, right? Another big thing is planning. Maybe Lorenzo will touch on this a little bit after me, but a lot of clients are asking, Mike, what the hell do I do with rate? What should I be doing? Should I be locking in? Should I be taking a 5-year? Should I be taking a 1-year? Should I be taking variable? What should I do? Well, the first question we get asked every day, Mike, Lorenzo, what's the lowest rate you can get me? Well, naturally speaking, it's going to be a 4 or a 5-year fixed rate. Yeah. Now, if you are to believe rates are going to continue to go up and our economy is completely going to shit and there's no positive sunshine down the road for us, then sure, lock in.
And even with the economy going to shit, well, when the economy goes bad and there's a recession, rates drop. So even if you're someone that does believe that, you have it's kind of catch-22. If the economy does actually go to shit, the rates will inevitably end up coming down to re-stimulate it.
Right.
But if you believe that, then maybe you consider a long-term fixed rate. But if you are the one to believe that unemployment's going to shoot up, we're getting our inflation CPI numbers under control, the bond yields are showing we're moving in the right direction, they're coming out. Tiff Macklin, what did he say the other day? He goes, maybe we can start considering to lower rates even before we hit our 2% inflation number. Well, now he's changing the whole dynamic of what they were really
I don't think I saw it, so he said that.
Yeah, he came out and said that. Take it with a grain of salt.
Right.
You're also talking about the Bank of Canada that said they were going to keep rates low for the next couple of years and did the friggin' opposite. So at the end of the day, you're starting to see that sentiment change where they're starting to maybe start to see the cracks coming. So back to my point is, if we believe rates are maybe slowly going to start to creep down over the next couple of years, maybe it is looking at short-term fixed rates, keeping flexible so that you're not tied to a bank and not locked in for a long duration of time. Yeah. Maybe the variable rate is getting brought up into the conversation as well right now. Why? Look what's happened with the last 3 out of the last 7 rate announcements. We've only raised a quarter point at a time, only 75 basis points over the last 7 meetings. So it shows like we might be losing steam with these rate increases with the Bank of Canada on the prime rate. So everything seems to hopefully be moving in the right direction, that there is light at the end of the tunnel. So it's all about staying flexible, having that conversation with your mortgage professional to plan, because the other thing with coming up for renewals, we can shop the market and lock in rates for you guys for up to 120 days and see how things play out over the next few months leading up to your renewal to see where rates go. At least you have the benefit of the doubt. You have something secured that in the event we can get you something better leading up to your renewal, or rates drop down and get you lower. But it's all about planning now more than ever in this volatile market. You need structure, you need planning, you need guidance. The second you make a rash spur decision is where you could be making the wrong decision.
Yeah.
Right?
For sure.
Sorry, I went on a tangent there.
Yeah, no, but it's good though, right? So it sounds like essentially what you're doing with some of your clients that are reaching out to you and calling you is taking a look at their whole entire portfolio, looking at their debt, restructuring it, and setting them up properly. Because sometimes they're like, I don't know if I should move this over here and pay this off or do this. But you need that expert eyes to take a look at it and say, look, let me look at it. Let me give you the 10,000 view,
the bird's eye view over top. That's it.
I don't know why I said 10,000. I need the exact measurement, but you know what I mean, right?
Yeah. The other thing we've been kind of, and not that this is also a good solution for everyone, but we've had a lot of people come to us saying, listen, I think if you're someone they think the real estate market's long term going to increase, they're at a place where they can't afford their monthly payments anymore, but they bought a little while ago, they have a little bit of equity in their home. One thing that we've been doing with a lot of people is because they don't want to kind of get rid of the property now, they think it's a bad time to do it, which I tend to agree, is that we've been accessing a little bit of equity in their home, maybe getting them a line of credit, or on their renewal getting them a little bit of bigger mortgage, maybe $30,000, $40,000, that can kind of sit in their bank account, help them just make their payments over the next 1 to 2 years, with the idea being when real estate does come back, they can then either reconsolidate all of that again or potentially look at selling their property at that point at a much higher value. So not necessarily that it's a great solution, but again, we've had a lot of people come to us in just spots where they just physically, maybe they don't even have a lot of other debt other than their mortgages, and they just can't make those payments, but they really don't want to sell. So getting obviously a little bit of a band-aid solution sometimes just gets you through the short term.
Right. What about, you touched on something there, stress tests.
Yes.
So not stress tests, loan to value.
Yeah.
So being able to pull out some extra money.
Exactly.
Okay, so we can go up to 80%.
Yeah.
I've heard talks of them potentially dropping it down to 65%. Is that
They've been
true?
saying that for years.
Okay.
I've been hearing that since even when COVID came out, and then all of a sudden they did. So that's something that there's always been a talk of. If you're buying an investment property, 75, 65% loan to value maximum, I haven't seen that ever. Honestly, I've only ever heard that on the news. I've never heard someone from a bank say that to me, to be honest with you.
Okay.
So yeah,
nothing to.
Not that I would be worried about today.
Yeah.
Could everything
Exactly.
could happen.
Hey,
But
at the end of the day, if it comes into fruition and that is the rule, you learn to deal with it, and that's the way of it. But we've been
Right.
hearing it for many, many years, and nothing's ever come into
and again,
fruition.
never someone of from a bank has told me that. I've heard
Right.
it from people on the news or people on social media. That I've never had someone from a bank be like, "Hey, this is coming down the pipe."
Right, some random guy on social media
Yeah.
while you're scrolling on Instagram.
Yeah. Did you guys just hear it? It's like I did not hear that.
Yeah, I know. You know what? And that's a good point too. You got to be careful where you get your information from.
100%.
Like you really do, right? Because
Like
there's
social
so
media is great,
much.
but there is so much misinformation.
There
out there.
really is.
There's a lot of money for people in generating fear, right?
Yes.
So especially those guys on social media. So if they're just out here kind of doom and gloom or just the clickbaity type of stuff, so there's a lot of money in that in a sense too, because you get people panicked, then phone calls start coming in. So that does kind of make sense in some people's aspect to do it. We're more of a this, and it's got to be more fun. Just be smart in a sense. Not necessarily a time to panic, but definitely a time to be very, very cautious and smart.
100%. Because I'm working with some investors now where they're like, okay, it feels like I'm going to start making some moves. I've kind of looked at what's happening now. Looks like things are starting to calm down a little bit. I can see that there's a lot of investors out there that have properties on the market who may not have been savvy,
Yep.
or they just want to get out of the market. They're willing to do a VTB.
Yep.
And listen, if you can get a VTB, there's some great opportunities out there where now you can get a VTB, interest-only payment. I've seen people do for like 4 years, 5 years,
I've seen that, yeah.
5%, 6%, and you're just going to wait for that market to stabilize or do some forced appreciation on there. And there's some great opportunities out there. People want opportunities to land on their laps, and this is the time to go out there and make it.
Exactly. And there's a lot of things. One of the things we've seen in addition to we've seen a lot more vendor takebacks kind of come into the fold. The other thing that we are seeing for especially investors is the assumable mortgages. So when you sell a home, most banks, it depends obviously your mortgage, you got to definitely check into it, but a lot of banks some banks will allow you to assume the seller's mortgage.
Mhm.
If the seller is okay with giving their mortgage up. If you're moving from your house to a new house you're moving into, typically you're going to try to bring that existing mortgage with a low rate with you. It's called a port. But if you're selling an investment property, a lot of times there's nowhere for that mortgage to go. So what we're starting to see is sellers kind of get smart to that, and buyers also get smart and ask about it, saying, "Hey, is this mortgage assumable? Can we assume it?" And all of a sudden now you got a monthly payment. You're buying $1 million home, just to kind of give you an example, and you're assuming a $600,000 mortgage at like 2.5%. You're saving yourself usually like $1,500-$1,600 a month, if
Yeah.
that's doable, right?
Right. Now you do have to be careful of the assumable mortgage, right? Like if I'm the seller,
Depends on your lender. Exactly.
I
Gotta
could
check.
potentially still
Yes.
be on the hook.
Correct. Depends
Yeah.
on the lender. So some lenders say no, like as long as the other guy qualifies, we'll fully relinquish you on. So again, just really depends on your situation. But if you're a buyer right now, why wouldn't you ask about it?
For sure.
Right?
It's an option available. That's what
Yeah.
Lorenzo. It's an
Yeah,
option available.
absolutely.
But I wanted to just say one thing, if you don't mind, Gary, what you were saying there. It's
Yeah.
like the biggest cliche line ever. It's like you got to be greedy when others are fearful, right? So at the end of the day, everyone has their own perspective on the market. But hey, maybe this was a correction that kind of was needed. You know what I mean? Like I get your rates are higher. Don't get me wrong, but that COVID era was a facade. We're in this issue today because of that. Rates got stupid low. It was essentially free money. Purchase prices got completely out of whack. Well, you're almost getting like a redo opportunity here.
For sure.
And there's a lot of opportunity. Like, are you the glass half full, half empty approach? Like, you were ready to go buy that house at $1 million, but your rate was 3%. You might be able to go buy that house today for $600,000-$700,000, but now your rate's 5, 6, maybe 7%. Well, it's all about strategy and planning. I'd rather be, as an investor myself, as a homeowner, I'd rather be getting that better deal on the property, trying to grind through these little bit of tough times with interest rates, than to have a massive big mortgage at a lower interest rate and then arguably be fucked down the road.
Yep.
You get what I'm trying to say?
100%. I think if you can get into it now is a good time. Can rates go up a little bit more? Yes. I don't think they're going to go up significantly more. And if you can handle it now, this allows you to get into the market today. And I really do believe that these prices of homes are going to continue to keep going up a year, maybe a year and a half from now.
That's
Right.
all it is at this point.
People are sitting there, they're waiting. You got immigrations that are like at record levels.
Yep.
And that's going to continue. And that's why I've talked about it before. I think the bigger fear for me is the market crash up. Like
Yep.
people not being able to get into the market.
Mm-hmm.
Do you have any concerns though with on the geopolitical front where you see the wars happening? And does that create more money printing? And does that then add to and fuel more inflation? And maybe they, I don't know, bomb Iran or the oil fields, or you know what I mean?
Definitely
And then
something
gas
to watch out
goes
for.
up. Are
Yeah,
those things
is
that
it like the front line concern? Not necessarily at the time, but should it be on the kind of top or close to the top of people's minds? I don't think it's something to be like completely petrified about, but I think it's something to be definitely keeping an eye out for, because let's face it, wars obviously impact rates, and rates directly impact us as consumers, as homeowners, as investors. So it's definitely something to watch out for, to see kind of how it progresses. In a sense, does the U.S. get involved? Does Canada, by extension, now have to get involved? Where do our rates end up going, because we have to now fund the war if that kind of becomes the case? At this point, though, and it's kind of a weird war, and it really depends. Like, what does Iran do? What does everyone do? Because if it stays as is, at the end of the day, not necessarily, it's a kind of like the Ukraine thing, it's more of a proxy war at this point. But if it doesn't, and all of a sudden it turns into something big, then yeah, it's definitely something to watch out for. Now, you might end up seeing, though, if they got to print a ton of money, you might see rates come down in the short term, right? Because obviously printing a ton of money, that's obviously QE coming into the fold. But now, long term, does that make things worse? Right, so it's like a cycle here that we're kind of entering, and so we're in the middle of, and we just got to see kind of how it plays out.
And if you're thinking that could potentially happen, I mean, look, it's very simple. Just lock in.
Yeah.
That was a normal thing, 10 years ago. It's like, when we were buying investment properties, we were like, okay, should we do a variable or should we lock in? I think in the last 3 years, people were just like, variable. Most people, not all obviously, weren't even thinking about even locking in because the variable's so cheap. I remember there was a time you could get a variable for like under 1%.
And that's the whole thing, right? And in fairness, it's like if you were like, hey, listen, as the rates go up, because the whole idea, like people were thinking back then was, well, if my fixed rate my variable rates, so say 1.5, my fixed rate was 2.5.
Yep.
Well, rates only increase by 0.25% at a time on a variable. That's kind of the norm. So you'd have to have 4 straight rate increases just to match that fixed rate. That would typically give people enough time to say, okay, I'm starting to creep up onto where my fixed would have been. Maybe I should lock my rate in now. Right, and you're still kind of ahead at that point. Now, when they go 50 basis points, 75 basis points, 100 basis points at a time on rate increases, you lose that kind of ability. Now you're faced with a tough call. I think it's exactly where you kind of were at with yourself. Do I lock in now, or do I wait, or what do I do? Because the decision's pretty easy when you're just creeping up to where you used to be, kind of thing, where it's like, okay, I'm almost getting it, let's lock in. I had a really good maybe 1.5 or maybe 7 months of low rate. Now I'm locking into still a low rate, obviously, but just a little bit higher. But then it becomes tough when that 75 basis point hike hits you. Now you're all of a sudden you're kind of caught out, basically. You're bag holding in the kind of the stock world, they call it.
Yeah. You know what it feels like as well, too, is that if the middle class isn't careful here, some of them will just never get into home ownership.
No, you're absolutely right.
Yeah, and I think it'll just become the norm where you'll see lots of families, they'll either just continue to keep renting, or I think you might be where now you're going to see families living with other families.
Like Europe, exactly what it is.
Yeah, because you're seeing that now with Bill 23.
Yep.
And Peterborough now just passed it as well, too, where you can now have 3 units on a property. And you're starting to see that throughout all the different municipalities. It's not like they really even have a choice. It's being
Which
mandated.
is good, because we need it now, right? To be honest with you, there's flat out not enough homes being built, and there's a ton of people, which is obviously immigration is like good, bad, whatever you want to call it. It's good to obviously bring people into the country that are kind of generating more stuff for our economy, but we're not building enough homes for them.
Mm-hmm.
And so now, and what does that happen? Drives prices up. So it's something that being able to add more units to properties, like I really like the idea, but you're absolutely right. It might be something where they call them like centurion families or something like that.
Yeah.
That basically the great grandmother bought the house and the whole family's lived in it ever since.
Yeah.
Right. And so that happens a lot. And that is, you're absolutely right. It's something that's where we might be going.
Yeah, it is. Listen, my son just recently moved out, and he's living with roommates.
Yeah.
Right? He's got people living with them, and he's the landlord and looking after the property. And but he also has good income.
Yeah.
But he can't afford a house on his own. It's just wild.
It's tough to
because these prices up. I mean, I think the stat is, at least from what I saw, like when we were looking at homes before, like my income was 2 to 3 times the price of my home.
Yeah.
Now you're like, for some of them, like 8 to 10 times.
12 I've seen. It's getting crazy. And with the qualifying rate as high as it is, they're making you qualify as if your rate's usually like 10%, or your actual payments like 8 to 10% of your actual mortgage that you're getting. So let's say you're getting a mortgage of $700,000. They're pretending that the actual payment on that mortgage is like $8 grand a month sometimes, which is not, that's the qualifying rate.
Yeah.
So if I only make 10 grand a month, which is a really good income, how am I going to afford that? Right. And not that that's straight, but that's what you're qualifying at. Right. And that's the whole piece where it becomes very tough for a lot of people. It's very rare that we're seeing kind of just single person income earners being able to qualify for something substantial, especially in the GTA on their own. Because again, maybe you qualify for a $500,000 home. Where are you getting that?
Yeah. Well, Peterborough.
Yeah, Peterborough.
Well, it's nice. It's nice that the prices are coming down and there is that slight correction. But to Lorenzo's point, the biggest thing right now is rates being high. Banks are throwing that 2% stress test at you. So as much as it's great, now the prices are correcting and we can maybe get a home at a better discount from where it's been over the last couple of years. It's still friggin' tough to qualify because the rates are so high.
Do you think has there been any talks about getting rid of that stress test? I've heard, but what do you think?
What was it at your mastermind course? This is kind of off topic, but like to hear that lady from the insurer go up there and say, we're having discussions, lobbying about extending like the less than 20% down insured first-time home buyer, extending the purchase price past $1 million, considering changing from a 25-year amortization, which is the maximum that you can qualify on when you put less than 20% down, considering maybe pushing that to 30 or so. Hearing that stuff it's cool to hear, and it makes me happy to hear that they're having these discussions behind closed doors between the insurers and the banks. But to your point, we have heard that they're considering not necessarily getting rid of the stress test, but maybe making it less strict and stringent. Maybe you're qualifying at your interest rate, but has anything come into fruition yet? No.
There is one though. The one thing that we'll say, so the governing body of, again, like that OSFI thing we've talked about, they had it in their kind of guidelines, and no one's ever really noticed it, that if you're on a renewal and you're just doing a straight renewal, they're okay with you qualifying at the interest rate that you're getting, the contract rate. So that just kind of came out where everyone really noticed it. So we're starting to see just on renewals, some banks, if you're doing a straight renewal, you're able to qualify the contract rate.
Which is great, but again, if you're trying to qualify for a purchase or you're doing a refinance, there's you're qualifying at that stress test based on the rate.
Right.
So there's some things that they're trying to make adjustments. I think they're starting to realize that people need help, and it's getting a lot more difficult in today's market. But
because you don't want to crush the middle class. You need that middle class.
I think so, and we're at a weird spot right now where I think that's where we're headed in a sense. The way things are going is it's the poor are going to get poorer, the rich are going to get richer, with asset prices kind of skyrocketing this way, and also being very tough for everyone else to acquire. Well, only the rich people are going to be able to get those assets, right? So the middle class becomes stretched at that point. If you have someone, it seems crazy that if you have someone making a salary of $150,000 a year, called that they're tight for money.
That's so wild.
And it's not even that they're financially responsible most of the time. Like their mortgage is paid half of their, it's just like expensive to live, right? So, and that's just crazy. Yeah. But it might be the new normal too, right? So it's just being able to adapt with it.
Now, talking about the middle class, I saw this article not too long ago as well too. I'm not sure if you guys saw this one here. So it says Canada is considering a guaranteed universal basic income program. This is no longer conspiracy theory. Like this is now awful. They're talking about this stuff, right? So like, what are your thoughts on that? Because this is, again, it's helping the middle class, and if the middle class feels they're starting to get wiped out.
I mean, is it helping the middle class though? At the same time, right? Like I'm a big believer if you teach a man to fish or give him the fish kind of thing. You're also disincentivizing work, right? Like looking for a lot of employers throughout COVID, when people were getting massive CERB checks coming in, they were just choosing not to go to work, not because their job didn't allow them to come back, but because they were able to apply for CERB, make most of what they were going to make working. Yeah. So why would I not just take the money, sit at home, and be able to play video games?
Well, what this does is it creates more of a social.
It's exactly Venezuela, right? That's what Venezuela is. 100%. Not that we'll ever get there, but
but now you're dependent on the government. Exactly. And when you're dependent on the government, it moves more into that political realm. Exactly. Of feed me. I need you to feed me.
Exactly. Right. And now no one knows how to do work for themselves. So, and not that we'll ever get to where that Venezuela was, but they were obviously, when oil was super high, they were just throwing money at the people like crazy. When all of a sudden the recession hits, hyperinflation happens, they don't know what to do. Yeah. They're a different situation in a sense, but there's some comparisons you can draw.
Right. You know, I'm trying to remember where I read this though, but it's something along the line. There's like 5 steps to this where it goes, like if I was to lend you money, first you'd be thankful. Yeah. Then the second time you would, I think, expect it. Then the third time you would need it. And then the fourth time you deserved it. Yeah. And then the 5th time it's like, it's your fucking fault.
Yeah. Or why'd you give me more? Exactly. Absolutely.
Right. And so you got to be careful giving money away like that. It's not just, give it to you and then now everything's going to be better.
And where's that money come from? You're printing it?
Exactly.
So is that causing anything to be better?
And
Well, no, we're printing more money now, right?
Right,
So
printing more money or taxing it, right? And
it's exactly what it is. It's so to me that's not necessarily a great idea. And obviously, like to be honest with you, that's almost the last thing you want to do, in my opinion. Just start handing out free money to people because we see, yeah, again, it's good for the short term. Long term, it always creates problems.
100%. Yeah, for sure. What about condos and pre-construction? Are you guys seeing any of that stuff coming through at all?
Yeah.
Still,
you still got clients that purchased many years ago and they're closing. They have no choice but to fund and close, right? So we are seeing everything from.
Yeah, I guess you wouldn't really see the new stuff coming in right now because they've got to wait anyways 3 to 4 years closer
Correct.
to when the
But there's a lot.
Yeah,
There's a lot of clients, new construction condos, freeholds, townhomes, just regular detached homes coming up to fruition, coming up to the closing. We're getting a lot of phone calls on that. Unfortunately, we see it all across the board.
What type of position are they in?
A lot of people can't qualify. A lot of people have no issues qualifying.
Yeah.
Maybe it's they qualified before, now they don't today because of today's rates and the whole situation. Their financial landscape has changed.
Yeah.
Maybe you're seeing a lot more alternate B lender side of the business, kind of wrapping up these deals. Sometimes we got to go private lender. Of course, we're always looking at other alternatives. Can we come up with more down payment? Can we get co-signers? Can we get partners on here to help qualify? But yeah, so there's always options. And again, this isn't to toot our own horn, but in general, as a mortgage broker, you have more options for a client than when you're just dealing with your bank or your branch directly. It's their box, their way or no way. Well, now more than ever, unless we've been living under a rock, you need more options, not just from shopping the market from interest rates. It's tougher. A lot of people have changed over the last couple of years from a qualification standpoint. Job changes, interest rates, credit, debt load. All of this plays an impact on how you can get financial financing through a financial institution today. So you need more options. Yeah. So yes, we're seeing the alternate B lender side of the game really pick up for clients that can help qualify if they fit their box. A lot of private lenders as well coming into the mix as well. But yeah, we've seen everything. We're not doom and gloom here. It's like, are we seeing sometimes appraisals coming in short? Sure, absolutely we are. Are we seeing issues with clients not being able to qualify when they did 2-3 years ago? Of course. That's just the nature of the world we're in right now. But you need to be working with someone that's going to have your back, hold your hand, and try to get you as many options as possible to fit your needs.
What are you seeing investors purchase right now in this particular market? And what's the percentage that you've seen, like in the drop of people purchasing from an investment standpoint?
Well,
because I know my business has been significantly impacted.
Investors have dropped down. Like most of our business was 80-20 investors. We're now dealing with a lot more just regular home buyers because that's what's in the market.
Switched,
Not 80-20 switch because obviously we're so investor heavy still, but it's been a significant drop off on investors and kind of what they're buying. I don't see many single family rentals come into the fold anymore.
That was going to be my whole point. We were talking about it on the way up here. We were on a call talking, and it's just like, it's tough to make a regular single family home work today just based on what can that property actually generate in a monthly rent versus today's interest rates. So you got a lot of investors, if they are into the market, you're looking at multi-units, duplexes, triplexes, fourplexes. We do a lot of commercial stuff. But yeah, so I didn't want to cut you off, Lorenzo. It's just the truth is like, of course, you've seen a drop off naturally in the purchase aspect of real estate naturally, but more so on the investment side. It's just because not too long ago, you could buy a single family home and go and rent it out and you were breaking even or you're making a few $100 a month just on a single family home. It's tough to do today.
Yeah. The only single family home that I see work in today's market right now is student rental.
That's different. They're different though. Not a regular just rent it out to a family.
Exactly.
Make your
no, it's got to be student rental. You got to be renting it out by the room. You got to have room upstairs, main floor, basement.
Chop it up a bit.
Yeah. You got to stick kids in every corner of that house.
Yeah, absolutely. Student rentals still aren't like some of the numbers I've seen. They're still working. But yeah, just normal single family's been tough. But at the end of the day, it depends why you're buying the property too, right? If you're someone that says, hey, listen, and not that you should or shouldn't do this, but if you're someone, maybe you got a lot of money, you're just buying purely for speculation, a single family home's probably going to be one of the ones that appreciates the most in a sense, right? Because obviously that's going to be one of the most desirable, especially if you have like a detached or you have like kind of not even just a condo, there's soil on it. That in the future might be one of the most desirable things to be able to get. Right, so it just depends why you're buying it too. I saw something, and people know Blackstone is. They've kind of come out saying Canada, specifically GTA and Vancouver area, is one of their top places that they want to invest in single family home real estate, which big companies like that don't usually do. And those guys aren't stupid, right? Those are some of the highest paid analysts and
BlackRock. Blackstone.
Yes, they're like the smaller version of that.
Oh, okay.
But yeah, they basically come out and said they're buying like subdivisions of single family homes in Canada. Because they see our whole thing with we're not building enough, and so they're like, yeah, but obviously the numbers work. No, but if we're a massive conglomerate that don't need cash flow, there's going to be appreciation there, and that's their opinion on it. So do I think they're wrong? They get paid a lot more than we do, so I don't think so. Like
if you don't need a mortgage and you can just buy these homes for cash. And you have a long-term projection of where they believe the price of these homes are going, they're probably right.
Yeah, which is why people buy stocks, right? Like, think about it, you didn't buy Amazon in 2003 to think it was going to go up the next month, right? Or so it's like, I don't think just like anything, long-term holds. Now, real estate's a bit different because it's done at leverage, so you got to be able to float those monthly payments and stuff like that. But if you're someone that does have the money, that's still not a bad idea. But a lot of our investors go to multifamily now.
Right. Yeah, like even, I've talked about this, I don't know if you guys know this, but I picked up a property down in Mexico, and their interest rates down there are anywhere from like 8 to 11%, and their market is stable.
And what's the purchase prices?
I picked up that one. It was a 3-bedroom condo for $256.
There you go, right? So it makes sense still,
Yeah, right? But it's a stable market, and it's a little bit more difficult to get into it, and you don't get these interest rates going down to like, that's what causes problems. And that's what caused our
And then
problems.
you get the massive spikes in the purchase price and the values going up, down, all of that. That's more of a flat line. Well, what were we talking about before we went on air? A couple of years ago, it wasn't too long ago, we were basing it off like when the rent-owns were very popular and stuff like that. You're basing your appreciation 5 to 7%. Like that was just a gradual growth.
Normal. 5%. I remember even some rental companies were even doing 3%. Yeah. But it was like that, like 3 to 6% on average, 4 or 5%, and that worked. And that was when real estate was nice and smooth. Maybe you'd have one other offer you had to compete against, maybe two, nothing crazy, but you could pick and choose.
Yeah, and what a lot of people don't realize too is funny. I was watching a bunch of stuff on this, kind of doing some research behind it. Yep. The reason that Canada's real estate, especially in our GTA, like Greater Vancouver area, has gotten so crazy too, is because anyone that has investment capital, 8 times out of 10, you ask them what they're doing, they own multiple properties. Where if you look at somewhere like the U.S., well, those people, it's a lot easier, a lot less red tape to invest in businesses, buy businesses, start businesses. So a lot of that extra investment capital that families have sometimes go into side businesses. There's a lot less red tape to open a business and succeed down there. Yeah. Versus here, it's so locked up and so tough and so many regulations to start a restaurant or whatever it may be that people just take their money, invest in real estate. So for here, it was like some crazy where like average people in the States, like not as many people like per area owned a home. In Canada, it was like for people that owned a home, most of them owned 2 almost. Right. Or it was like 1.6 or something like that. And it just goes to show that just something like that too, where Canadians don't necessarily have as much options to invest sometimes, makes real estate that much more wanted here, and then obviously drives the price up still.
Right. I think though, after what we're going through, I think you're going to see a lot of investors not come back. I think it'll be like the late 80s, early 90s where the baby boomers, because they were starting to get into real estate investing as well too. And then that market took that hit and they're like, fuck that. Yeah. I'm done with that. And then they're out. And you didn't see that again until, I would say COVID.
Yeah.
And I think people are going to get flushed out and they're like, nope. And they go back to work and their coworkers like, I fucking told you. I told you, stay right here in this cubicle with me.
If you just would have kept, and obviously it's tough for some people, but if you just keep kind of fighting, there is a light at the end of the tunnel. 100%.
I was talking to Harry James about this as well too, and we had a conversation. I said, so what do you tell somebody who got into the game during COVID, and they're getting crushed right now, and they're having a difficult time, and they're like, man, should I have done this? And he just goes, welcome to the game.
Yeah,
you're no longer in the bleachers. You're actually on the field. Yeah. You're playing the game, and this is how it works. You can't always win.
And it's investing. It's not if it goes straight up forever. Like that's awesome. But who's that? When does that ever happen in history? Right? It's a roller coaster. That's what happens.
100%. Like I've won a lot, and now I'm taking my hits. I took my hits last year. I'm taking my hits this year. It's just part of the game.
The long-term gain over 10 years, as long as your wins outweigh your losses, you've won.
That's it. And I'm learning and I'm adapting and I'm not crying about it. It sucks, but I just got to deal with it.
Exactly.
Right? And learn, pivot, adapt, and that's just the name of the game.
Well, what's the line? It's not timing the market, it's time in the market. And I'll quote you. What have you always said? it's not supposed to be get rich quick. It's supposed to be get rich for sure. But
Yeah.
coming out of that COVID era, you're going to wean out a lot of the shit because a lot of people took their lumps. They bought at the peak. They thought we can ride this wave up and it's going to last forever, and it didn't. So it's all about numbers. There's no emotional attachment to investment real estate. It's numbers. Can I get through this? Can I make these numbers work? Do I believe that there's upside? To Lorenzo's point, investing is supposed to be long term. It's
Yes.
supposed to be,
100%.
right?
And I think people forgot that. I think people were expecting those perfect burrs, and they want to do 3 or 4 perfect burrs every single year.
And then
that's
they
not
quit
the
their
game.
job. They're like, I'm doing this full time. I did a perfect burr. I got all my money back, made a couple $100,000. Let's do the next. Hey, if you timed it and you did it, great. But
Yeah. And so, listen, for anybody that's listening, and you got hurt, you got crushed, I get it. I feel your pain. I'm going through it as well too. A lot of other people going through it as well too.
100%.
But you just got to persevere, and it's just part of the game.
Exactly.
It's part of the lumps you got to take, and the bruises and the cuts, and that's just it.
And the other way to look at it too is a lot of people bought homes at basically 100% leverage because they got a line of credit on one home,
Yep.
used it for the down payment of the other home. So you've really put not necessarily any of your own personal savings into it. So if now you're like, hey, now I got to fund the property, $1,000 a month, $500 a month, whatever that may be, you've only put $500 of your own money into the property every month, right? So it's like, especially to kind of a little bit of perspective too. It's not as bad as you think if you actually bought the home at full leverage, basically.
Right. Yeah. And you look at it as like almost like a forced savings.
Yeah, exactly.
It's just a forced
Savings account,
savings.
exactly.
$500. I get it. You know, you want positive cash flow, but
Yeah.
it's okay.
Exactly.
Now you're putting some money into your, we'll call it RSPs.
It's exactly it.
That's the way you got to look at it.
Exactly.
Right?
It's like if I was to tell you, you can take a mutual fund and make whatever 1%, 2% a year, whatever they end up giving. Now some of the GSEs are high now, but obviously you get like a kind of a normal stock portfolio and you have to put in $1,000 a month, or you get real estate and it's the same thing.
Yep.
But the return sometimes could be way bigger. Would you do it? Most people would say yeah.
Exactly. We touched on a lot here.
Yeah, I was action packed.
Yeah, but it was good. Woo.
has it
We-
been
no
has it been an
commercial.
hour?
Yeah, we're pretty close to it.
Holy
Pretty
smokes.
close to it. That was good, man. Was there anything else that you guys want to touch on before we kind of wrap things up?
I mean, for us, it's just our big message, people, is just making sure always be prepared in this point, right? It's not that you have to go buy right away and this. Obviously, is it the time to buy? Is it not? It's kind of everyone's decision. It's a good time, in my opinion, but it's always be prepared, especially if you own houses or you're someone that wants to buy a house. Kind of getting in contact with your realtor, your mortgage person, kind of figuring out what you're able to do, or if you have a renewal coming up, get yourself well prepared, like 6 or 7 months in advance. We've been pretty active trying to reach out to all of our people with renewals that we know have renewals coming up at least 8 months out, just to start getting ready, because last thing you want is for people to kind of stuff sneak up on you. So it's just, I guess the biggest thing, our message has been lately, just get prepared for what's happening, kind of reach out, talk, and at least now we can get not that anything has to be done right away, but at least a plan's in place.
I agree with you. You know, I think right now is a good time to be out there looking and getting ready to invest.
Yes.
Is it the bottom? I don't know. But are we close to the bottom? I would say yes.
Exactly.
So don't worry about trying to time exactly where that bottom is. I think now there's opportunities out there. There's people that want to get out of the market. And if you're trying to think about getting in, now's a good time, I think, to really get into it.
And right, like reevaluate your portfolio. If you got 5 or 6 houses, which one has more upside to, like, work with your realtor. Which ones have more upside to them? Do I keep? Which ones maybe not as much upside? I've kind of maxed out the potential. Maybe that's when you get rid of and redeploy, right? Work with the mortgage person. Can you do all that? So it's a lot of time for me right now. It's a big planning time.
Yeah. I'm trying to think now, like I haven't purchased a property in a number of years, well, outside of my Mexico property. And now is the first time I'm excited again.
Yeah.
I feel like this is, it smells like fear. I like it.
Yeah.
Right? But this is, it feels like 2008 again. Like I'm excited again. I'm like, okay, cool. People are scared. This is where you make smart decisions in fear.
Yeah.
Because now you're looking, you're calculating, okay, did I cover all my bases? When there's no fear, that's when you make mistakes. Because you think things can't go wrong.
Yeah. You lose your principles, all that stuff. Exactly.
Right. You're like, I'll just buy anything.
The fundamentals go out of the window because everything's just too easy.
Right.
Right?
Exactly. Any last words of advice from you, Mike?
Yeah. I'm going to echo exactly what Lorenzo said, and I said it. Planning is key. From every component, you have an upcoming closing, to wanting to get into the market and consider running your numbers because you want to make that jump, you're seeing the opportunity, to upcoming renewals. It's just planning. Have the conversation, put a plan in place. At the end of the day, we started this off, every day above ground is a good day. Every day you wake up is a good day. It's how are you planning for tomorrow? That is the key here.
Exactly. Yeah. Determine what you want and go figure it out and sit down with the right people and get it.
Absolutely.
That's it, man.
And thank you for having
Yeah,
us.
thank
man.
you
All right.
for having
Thank
us.
you.
It's
No
always a good
problem,
time.
guys. Awesome. I appreciate it.
Thank
All
you.
right, we'll do this again soon.
All right, buddy.
Awesome.
Wicked. That was a good one.